So good evening, everybody, and welcome to our class on continuation of demand and supply. Um, Sorry that this class is a bit late. I had exams this evening, and somehow I was still sleeping by 9. I just woke up. All right. So before in our last class, we talked about introduction to demand and supply, and we also introduced 6 things that we can use to validate a demand zone. The first one, we talked about break of structure towards to the upside, meaning that any zone that you're looking towards a demand zone or a valid demand or supply zone must break structure. Now, what I meant by that is, let's say you're considering a level as a level that you would like to buy from in the name of a demand zone, right? It means that that level, the demand zone at that level would have sponsored price to put in what a higher high, meaning that the new high must go above what the previous high, right? So in cases like this now, let's say this was the previous high. Let's say something like this now. This was the previous high. It means that this is not a valid demand zone, right? Since it didn't take out our previous lower high in this case, right? So which means that for you to say that a zone is a valid demand or supply zone to buy from, you must what? You must put in a new break of structure, right? And then the next one that I talked about, I mentioned I mentioned the direction of the trend, right? Direction of trend. Now, this is one of the most important of our 6 validations, if not even the most important, right? Because you understand that when you are buying when you're buying, you want to be buying what's in the direction of the trend. When you're done mapping out your market structure, we've done market structure, right? For those of you that are following properly and that are doing assignments, you understand that I mentioned that when you come to your chart, the first thing you do is to map out your market structure. You can never just like jump into something else, like maybe you just like start looking for entries or anything. The first thing you do before you can get your entry is to check which direction is price going. And you already know that the way to determine the direction of price is to map out structure. You get into the chart. For some of you, there are times you like get so good at market structure that you don't need to carry your tools to start doing what to start mapping out lower highs, lower lows, this and that, right? Just by looking at it, you know what price is doing, where price took out the previous time, what happened there, what is happening, and the rest of it, right? So as I was saying, the most important thing is to map out market structure, see where price is coming from and where it is what it is going to, and you must trade that with you must trade what in direction of that where price is going to, right? So which means that if you should map out the market structure and price is currently in an uptrend, it means that you'll be looking out for what just demand zones. You're not selling in a buying market, neither are you what buying in a selling market. The next one that I mentioned was what the premium and discount. This one I gave a scenario where I talked about every one of us here. Now let's take trading aside, right? Everything you're doing, you want to make sure that it costs you less, right? You want to make sure that whatever you buy less. Some of you have followed your moms to the market or your sisters or something. And then you see them, you see when people tell them that, oh, this is the price of this thing, you see the way they price, right? Someone can tell them that, oh, this thing costs what, 2,500, and they're like, what to sell for 1,000. Do you understand? It's different when they are the ones selling and no longer buying. Something can cost 2,500 and they'll put the price there. Oh, how much is this? They'll tell you 4,000 first. So that even if you're pricing, right, you may even likely land at 3,500 or something. So people are looking towards buy at cheaper prices and sell. Give me a minute, please. People are looking to buy at cheaper prices and sell at higher prices, right? So which means that as traders, you want to be buying at discounts and selling at premium. And I told you guys that how to map out this premium and discounts is very easy. All you need to do is use your Fibonacci 2 or your Gann bus, and then you map out from a structural low to a structural high. In an uptrend, you'll be mapping out from the higher low in consideration, which is the one that creates whatever demand zone you're looking at, to the higher high of that same price leg. And when you're mapping out in a downtrend, you're mapping out from the lower high to the lower low, just like this on the chart. If you look currently now, this is a lower high, and this is a lower low, right? This is a lower high, and this is a lower low. This is another lower high, and this is another lower low, right? Now let's say I was looking to take a particular trade setup from a demand zone at this point, right? What do I have to do? I'll take my Fibonacci 2 or my Gann box, and then I map out from this lower high to this lower low to make sure that whatever zone I'm looking to buy from or to sell from, that it is in the discount for the buyers. Let me change this to black so it becomes more rich. I'm coming. Let me use another color that is different. All right. So you want to make sure that in the downtrend, after marking out your Fibonacci 2 from a lower high to a lower low, that your supply zones, whatever supply zones of consideration, right, are in this premium. And if you're buying in the case of an uptrend, that your demand zones are in the discount at all times. If you have a zone that has met all of your other criteria that validates a demand or supply zone, and that particular zone does not meet just one, which is the premium and the discount. Let's say it meets everything, but it is in the premium for a demand zone. It is still invalid. It is not a valid one to buy from. This particular validation is non-negotiable, meaning that you can have something look like a high probability, but the moment it is not in the discount as a demand zone, or it is not in the premium as a supply zone, what happens? It is now invalid to buy or to sell for. So which means that this is non-negotiable. The demand zones must always be in discount, and the supply zones must always be in the premium. Now the next one that I talked about, I mentioned a form of inducement. Okay, before inducement, let me talk about sweep. So I talked about sweep the last time we met. Now, sweeps, I told you guys that price may not always sweep, right? Because there's something like this. There are times whereby price can create a chain of mitigations, just like this, where every higher low is mitigating the where every new higher low is mitigating what the previous higher low, right? Something like this, creating what a chain. I think in the next class I should talk about order flow before I continue, so that I explain this properly, right? That price can do something like this. So it's not every time that price sweeps. For the newbies, a sweep is just like when price takes out what a low or a high and continues what in that direction. Let's say you have something like this. Price is an uptrend, right? And then price now takes out this most recent vehicle structure here, takes out this particular low here, and goes ahead to what, mitigate this one and still continue in a buy position. Something just like this. This is what the sweep looks like. Price taking out a low and still ending up continuing what in that same direction. I think for most of you, like people that were trading before now, you probably heard people say what I was stop wanted, I was taking out, I was this, I was that, right? So when price strips out a low or a high, it has swept what liquidity resting on that low or high. So these swings are part of what validates our demand or supply zones, because demand or supply zones that have actually swept liquidity before probably creating that area of supply or demand makes it of higher probability. But this is not always true. This does not mean that without strips we cannot have what valid demand or supply zones, right? Now the fifth one is the imbalance, right? I told you guys the last time that we met that in the market buyers and sellers have equal opportunities. These equal opportunities means that the market is not meant to favor one side of the market, like probably favor buyers or favor sellers. Do you understand? At every time, there are equal opportunities created for both buyers and sellers. So in case scenarios whereby market was what only buying, you would notice that right after, like prices was going to come back to what sell to cover up for the time that only buyers were in control of the market. So you would notice that this imbalance is just like when you go on your chart and you see what multiple buy candles without what a sell candle. This is an imbalance in the market because the market is made up of what? Market is meant for what? Both buyers and sellers. So when you see multiple green candles in the market, the price is just buying, and you're not seeing any bearish candle. It is what? It is an imbalance. Right? It's not supposed to be so. And that is why you see that most of the times the price creates this imbalance, it always comes back to what? It always comes back to fuel them. If you look at this now, as at this point, we had this first candlestick here. We had this second candlestick, this third was bullish candlestick. And then what happens? After a while, price does what? Price goes back to feel the imbalance resting on this particular level. So for every time the price does this, one green candlestick, two green candlesticks, three green candlesticks, as much as it wants to, it always comes back to create a corresponding bearish candlestick. And that is why you see that every expansion has a retracement, both in an uptrend or in a downtrend. Price does not only expand without giving room for retracements. As he expands, it retraces. As he expands, it retraces. Like if you look at what happened here on this particular zone here now, we had what? We had the first bullish candlestick, and then price went ahead to create a second bullish candlestick without giving sellers any say in the market actually. And then did went ahead to create a third bullish candlestick, and then the fourth bullish candlestick that mitigated the third. And you can see that in this case, price has created an imbalance in this link, right? Where you have multiple buys without multiple spacious buys without any sell candles in between. It is a form of imbalance. And then you can see that what happened. price later came back to sell, to fill in some sell candles before what continuing to the upside. So these imbalances, they are just like price magnets. They attract price to it because for every time the price creates those imbalances, it always comes back in the opposite direction to fill the imbalance created, right? It always comes back to us to fill this imbalance that it has created. So even in the case of, let's say you had a bearish one, you would see that what the price comes back, retraces in. Like if you look at what happened here now, we had series of sell candlesticks without price buying. In this case, there was an imbalance created at this level. And what happened? You can see that price retraced to fill the imbalance resting up to a point. And even at this point, this was the point that price was cleared majority of the imbalance there. So price may not, even if it's not today, it is not tomorrow. But price always comes back to fill these imbalances. And that is where you can apply the knowledge of expansions and retracements. For every time the price expands without giving sellers a chance in the market, you just see multiple buy candlesticks without any sell candlestick at all, right? For a while. That has created an imbalance in the market. Imbalance, what is an imbalance like? Let's say imbalance, something that is unfair. It is not fair, it is not balanced. That is what an imbalance is. So for something not to be balanced in the market, it means that one side of the market has been, will I say, cheating. You understand? One side of the market has been winning. We have the other side doing anything yet. It means that the market is imbalanced. And when something like this happens, the market comes back to rebalance itself by filling the gap that was created by that one side of the market. So when you have these long runs of bullish candlesticks, you anticipate that the market will come back to fill them to an extent. And when you have this one of bearish candlesticks, you anticipate that the market will still come back to fill them to a good extent. When we get to imbalances in our subsequent class very, very soon, we look at more chart examples. Now, the number 6 one that I talked about that we're going to look at on the chart is the inducements. Now, inducements are non-negotiables. The moment you don't see any form of inducement before your demand zone, just know that particular demand zone is the inducement that you should not buy or sell from. Now, the most common type of inducement is the recent break of structure. The recent break of structure is the most common type of inducement, which means that at no point would you be mapping out a recent break of structure as a valid demand and supply zone. Now, here's why. In an uptrend, we have series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. And I told you that every higher low in an uptrend are demand zones. Every lower highs in a downtrend are supply zones. But I told you that just that they are not all valid to buy or to sell from. But are they demand or supply zones? Yes. Are they all valid to buy or to sell from? No. It's just like establishing the fact that in this everybody in this school are either boys or girls, but none of them are like some of them are now different when you're looking out for like your choice of partner or whatever. They're not the same. It's just like this again. Every higher low in an uptrend are demand zones, but not all of them are valid to buy from. Every lower high in a downtrend are supply zones, but not all of them are valid to sell from. So when you're done mapping out your market structure, I told you that now this particular recent break of structure at any point is no longer a consideration for you. The most recent break of structure at any point in the market is not a consideration for you. It is a form of inducement. You know that for every time the price comes to mitigate a demand zone, what happens? Um, this is because people are anticipating that the lows in an uptrend are protected lows, while the highs are targeted highs. So they are anticipating that as price comes forward to that low of what an uptrend, it will reject. As price comes to the low of an uptrend, it will reject. As price comes to the low of an uptrend, it will reject. It means that for when price pays this what when price pays this recent bit of structure, there are a lot of people anticipating that what the price rejects from here. There are a lot of people looking to buy here. And I told you that any zone that a lot of people are looking to buy or to sell from is a zone that can create liquidity for price. When price senses that there are a lot of orders resting on this level, what does it do? It sweeps that level to pick the money and drive as fuel. I want you to look at liquidity just means money, right? And it is a fuel for price. You notice that sometimes immediately price sweeps that your for people that are already trading before now, you would have noticed that there are times whereby immediately price sweeps that's your point of interest. It starts going in your direction in a faster way. Those liquidity that it has swept at that level has what fueled it. It now moves without interruptions. And that is why you see that most of the times, the most recent break of structure, what price usually takes it out. Majority of the times, this is speaking on at least 80% of times that you map out market structure. The most recent break of structure, price usually what takes it out. So which means that you're not buying at the most recent break of structures. Instead, you're using them as a form of inducement, not on liquidity and inducement. But I think before I conclude the demand and supply, I'm going to have to touch liquidity and inducement so that when I'm mapping out demand and supply zones, you guys won't be you guys won't be confused. That is what I'm going to do in the next class. I will introduce liquidity and inducement before we now go to putting everything together that validates what a demand or supply zone. So these are the 6 things that I talked about showing you what on the chart. Number one, the break of structure in direction of the trend, which means that when you have established that price is bullish by mapping out your market structure, or you've established that price is bearish, mapping out your market structure, whatever level of demand or supply that you would like to buy or to sell from must break structure. Breaking structure, I told you, is taking out the previous high in an uptrend or taking out the previous low in a downtrend. And then the next one is the premium and discount. I already told you guys how to mark out the premium and discount. Any price leg you're looking at, all you have to do, let's say in this case now, let's say that this is an area of consideration for us. We're looking to buy from maybe this level, right? This is a higher low. This is a higher high. This is a higher low. This is a higher high. All you have to do is to pick up your Fibonacci from the higher low to the higher high. It means that any level of demand that you're looking at must be in this discount. And you can see that this was the level of demand the price bought from this demand at this zone. So which means that the demand zones in this premium are not your business. They are not valid demand zones to buy from. You're looking at your demand zones from the discount. And if it was in a case of supply, your supply zone should be from the premium. At every point, this is this particular one is non-negotiable. I mentioned. And then the sweep, I told you guys that when we get to liquidity as well, that is when we talk about liquidity sweep. These things are always intertwined. Like most of the times, you notice that you would need to understand one properly to understand the next. Because at the end of the day, you would put everything together. That is why for market structure, you're already mentioning demand and supply, or you're already infusing liquidity and the rest of them. They always go along. And for the sweep, I told you that it's not a must, because when we talk about order flow mitigations, you would realize that it's not every time that price sweeps liquidity from structural highs and lows to continue or maintain a trend. When we look at chart examples, you'll see that one as well. And then I told you that imbalance are price magnets. It means that you know what a magnet is. Something that would attract something to itself, right? These imbalances they attract price to itself. And I told you that you just have to visualize this or understand this with the fact that at every point in time, the market creates equal opportunities for both buyers and sellers. So imagine a case scenario whereby only the buyers are just buying. It means that it is no longer as balanced as it is. And when something is not balanced, that is when you see that that thing is what either unbalanced or what imbalanced. And that is the concept of these imbalances. When price creates these things, these buy zones, multiple buy candles without a sell candle, we are now anticipating that it will what it will come back to fill that imbalance. So having an imbalance before your entry kind of gives you what an assurance that price will come back to that entry, right? To maybe fill the imbalance and then pick up the order. That is why it is on our list. And then the sixth one is what is the inducement. Now, inducement and liquidity is broad. What I'm going to do is that before we start mapping out our demand or supply zones as buy zones, right? When we meet on Wednesday, I'm going to start liquidity and inducement. I want it to be that you guys understand this particular concept properly before I ask you to start mapping out demand or supply zones, or before I start mapping out demand or supply zones on the chart, or before I start showing you how to map out demand and supply zones on the charts, right? This inducement, that's what we're treating next. We're starting liquidity and inducement, and then coming back to demand and supply zones right after. I think we should do everything this week. This is just Monday. We still have Wednesday, Friday, and Saturday with classes. So I think this is it for today. If you have any questions, just drop your question on the question subtopic. The recording for this class is going to be made available. For now, this is still like the intro class too, because we've not started validating yet. But if you have any questions, just drop your question on the question subtopic. If you think it's something related to the class, then drop it in my DM instead, not on the sample group. Right? So I'll see you guys again on